Good morning, everyone. On behalf of Axis Bank, I welcome you and wish you a very good morning on this Saturday. Okay. At the outset, we would like to thank you for joining us on this session that we have planned along with Ernst Young, a big five player in the taxation piece. We are at that time of the year when all of us are actually trying to maximize the money that we can save through various investment options on the income tax that we pay. We have about a month to go for the end of this financial year, and we thought that this is the best time to relook at all the options which are available. And if at all any of us have missed out on any of these, to try and quickly take advantage of all of this. So, in this session today, over the next hour or so, there are a couple of aspects that we will try and cover. One is all the options which are available under the Income Tax Act, which we as individuals can use to save tax. Okay. Uh, in addition to that, if we look at and consider the various incomes that we earn through these investments, whether it is in the form of capital gains, interest, or dividend, what are the provisions in the Income Tax Act with reference to the income that we earn and the tax that is payable on that? We thank you for the fantastic response that we've received for this session today. We have received over 500 questions, and hence, after the initial part, when the various provisions and details are shared with you, we will also take up some of these questions. Okay. What we will try and do, given the limited time that we have, we will try and take up the questions which are generic and which have come from multiple participants who are there as part of the call today. There are some very specific questions which have come from various individuals. Time permitting, we will try to take those up as well. Right. However, please do excuse us if we are unable to take up some of those specific questions that have come in from each of you. So to start the session today, I would quickly like to introduce our speakers from Ernst Young. We have Mr. Mayur Shah, a partner in the People Advisory Services. He is based out of Mumbai and has over 30 years of experience in corporate direct tax, personal tax, and regulatory matters relating to multinational and domestic clients in a wide range of industries. He has worked extensively in the area of global mobility and employee taxation from inbound as well as an outbound perspective, with experience in dealing with tax, social security, and other regulatory aspects and issues. He has experience relating to exchange control and the interpretation of double tax avoidance agreements, especially in relation to global employees in transactions, tax litigation, and tax issues relating to the design and implementation of stock-based incentive plans. He has also assisted in alignment of payroll tax positions for entities in transactions in various sectors, including the financial service sector, infrastructure sector, the professional services sector, automotive, and manufacturing companies. He has also authored many articles on tax issues for leading newspapers. He has also been a speaker at various tax seminars and conferences in India and has authored many articles on tax issues for the leading dailies. He is a Bachelor in Commerce from Mumbai University and also a chartered accountant. Along with Mayur, we also have Ekta Tulsan, manager in the People Advisory Services practice at Ernst Young. She is also based out of Mumbai and has 11 years of experience in personal tax for multinational and domestic clients in a wide range of industries. She has been working on expatriate tax compliance for companies with a global footprint, both from an inbound and outbound perspective. She is also involved in advisory focusing on area of Indian Provident Fund and global social security tax planning, optimization, and compliance. She has also assisted in formulating tax-efficient and flexible compensation structures while ensuring that such compensation structure is legally compliant and easy to administer. She has also been handling the tax affairs of several high-profile senior executives and high net worth individuals. She is a Bachelor in Commerce from Mumbai University, India, and also a chartered accountant. She also holds an advanced diploma in international taxation from the Chartered Institute of Taxation, UK. So thank you so much, Mayur and Ekta, for joining us today and helping our investors and customers in trying to plan the taxes for this financial year. So with this background, thank you once again for joining in today, and I now hand over the floor to Mr. Mayur.
Good morning, everyone. Thank you, Naval, for such a wide and good introduction of us. Uh, I hope, with this slide deck, I am sure that all will be gaining something. Not only you, but your questions will also make me think differently in this situation. So therefore, I am very much upbeat about, joining this session. And I would like to thank Axis Bank for inviting me for such a seminar. And I would like to welcome all the participants uh, to join this on my behalf as well as on behalf of my firm. Uh, Today, what we are going to cover is in respect of how to save taxes. I think more often than not, what we do is that we have certain needs, and we need to fulfill those needs. When we have such a need and we need to fulfill, is there any other additional advantage we can take on? And that's where we can think of making investments, which helps us all not only in investing in the way we want, at the same time, how we can save tax thereon is also an aspect which we can consider. And our commercial decisions are never based on just tax saving, but it also means that whenever I'm investing something, how I can earn better return on my investment. And when you are saving some cost, that is also considered as return on investment, and basis which one can decide what investment one need to go for. Once we decide that we want to make certain investment, what are the stream of income which is going to get arise and how it is getting taxed? And that's where we are going to talk about what are the capital gain tax implications when we are making investments, and what happens if return on investment is arising on a regular basis and how it will be taxed. So let us first look at how tax saving investments are to be made, in which areas one can make investment, and how we need to deal with it. Ekta, I would like to invite you here to explain how tax saving investments can be made.
Thank you, Mayur. Thank you, Naval, for a very good introduction. Good morning, everyone. As Mayur just rightly pointed out, there are several investments which not only provide you with a good return on investment, a saving opportunity for your future, but they will also help you to minimize your tax liability. Let us together now have a look at some of the most prominent tax saving investments which an individual taxpayer can make. Section 80C. I think this is the most commonly used tax deduction in India. You can claim a deduction of up to 1.5 lakhs every year based on the payments and investments you make during a financial year. The Income Tax Department has provided list of categories and subcategories of investment under which an individual can make investments to claim this benefit on a yearly basis. Few relevant ones are life insurance premium for life insurance policy for yourself, spouse, and dependent children. Contribution to public provident fund for your spouse, yourself, and your child. Contribution as an employee to recognized provident fund. Contribution as an employee to approved superannuation fund. Contribution for participation in unit-linked insurance plan of UTI in name of yourself, spouse, or child. Subscription to notified deposit schemes such as Sukanya Samruddhi account, in which the amounts can be deposited for a girl child who is your daughter or for whom you are a legal guardian. Investments in various notified savings certificates such as a national savings certificate. You can also invest in term deposits with a lock-in period of at least 5 years with a scheduled bank, which has to be in accordance with Scheme 11. Additionally, deduction can be taken on amount of principal repaid on housing loan or investment in equity-linked saving schemes. There is also a deduction of which is available for contributions made by an individual towards annuity pension plans, which are offered by LIC or any other insurer for receiving pensions. One of the most trending investments, and which is really upcoming nowadays, is national pension system, where an individual can voluntarily contribute and save for his future. Such contribution not only provides you attractive tax saving at the time of withdrawal, but it also enables you to claim a deduction at the time of contribution from your yearly taxable income. For an employee, the tax deduction of his contribution would be up to 10% of his basic salary, whereas for other taxpayers, the deduction can be up to 20% of their gross total income in a financial year. Aggregate amount of all the deductions which we have discussed till now cannot exceed INR 1.5 lakhs per financial year. However, NPS provides you an additional opportunity to claim additional deduction of 50,000 per financial year, provided your limit of 1.5 lakh, which we just spoke about, has not got exhausted. So to give you an example, if the aggregate deduction of your ATC investments is up to 1.25 lakhs, you have 25 lakhs limit, which is pending. Say you contributed to NPS of till 65,000 in a year, then 40,000 deduction can be additionally claimed by you under this particular provision of the law. Going ahead, purchasing a health insurance policy can not only give you a safety net for medical emergencies, but it can again help you to optimize your taxation. You can claim a deduction of up to 25,000 for any premium that you paid on medical insurance policy for yourself, spouse, and your dependent children. You can claim additional deduction for payment of medical insurance for your parents of up to 25,000. If any of the people for whom the premium is being paid is a senior citizen, then these limits can go up to 50,000. You can also avail the benefit of paying for preventive health checkup in the said limits. ATTT and TTD are also again commonly used deductions in India. These are basically deductions of INR 10,000, which for a normal individual can claim up for your interest, which you are earning from your savings bank account. However, if you are a senior citizen, you will be able to claim a deduction of up to 50,000 from any kind of interest, which includes term deposits. So saving accounts as well as term deposits in case of senior citizens. Under section 80EE, you can claim the benefit of the interest portion on housing loan. This was mainly introduced by the government to propagate affordable housing in India. There are certain conditions under this deduction, such that the value of your house property should not exceed 45 lakhs. The amount of your loan should not exceed INR 35 lakhs per year. The deduction that is available to you is 50,000 per year. The good part over here is that this deduction is in addition to the interest on housing loan that you can claim while computing the income from house property. That is limited up to INR 2 lakh. So overall, if you are claiming a deduction in section 80EE, you can get a deduction of 2.5 lakhs. One point that needs to be noted over here is that the loan that is being availed has to be availed between the period 1st April 2016 to 31st March 2017. Similar provision has also now been introduced again for the loans which are availed from the period 1st April 2019 to 31st March 2022. The deduction is now increased for these loans up to INR 1.5 lakhs, and there is no cap on the amount of loan that a person needs to avail. However, the cap of value of stamp duty or the stamp duty value of the property of being 45 lakhs still remains. Under section 80E, an individual can claim deduction of the payment of interest on education loan. This deduction can be claimed till the time you are having the loan for yourself, your spouse, or your children, and even for someone whom you are a legal guardian. There is no cap on the amount of interest you can claim in this section. The only restriction is that you can claim this deduction for a period of 8 years from the date you have started repaying the loan, or till the time you have completely repaid the loan, whichever is earlier. Now, I would want to hand over this session to Mayur to explain how the capital gain liabilities are taxed in India.
As we have discussed that, when we make investment, there is likely to be many income which is going to arise. And the most important income which arises is on account of transfer of such assets. When we are transferring such assets in the year, when it is being transferred, it becomes a taxable event, and how a tax needs to be paid on that. First of all, when we are transferring income, certain transfers is exempted from taxation, such as when any gift is made, to relatives, or if any property which is being transferred to the trust, or similar such kind of transactions which are there, where capital gain taxation does not arise. However, when other than that, any transfer which is being made, whether payment is received in the same year or not, that will become a taxable event on the date of transfer. Having said that, I just want to provide one example that we have sold a property on say 29th of March, but the payment is received only in the month of April. The question always remains whether it is taxable in the month of March, because year is ending on 31st March. Therefore, it should be taxable in the year when it is ending on 31st March, even though payment has been received in April. Having said that, whenever any capital gain is done, that gets classified into two kind of capital gains: long-term capital gains and short-term capital gains. The question arises that why we need to classify this into a long-term and short-term. There are two reasons. One, long-term capital gain needs to be calculated in a peculiar manner, and short-term capital gain needs to be calculated only on a normal method. Secondly, the tax rate which needs to be applied for long-term is very different from short-term capital gain. And as a result, it is imperative for everyone to classify sale of assets and gain arising therefrom. Either it is long-term or short-term. Then the next question arises that how do I find out what is long-term and what is short-term? That short-term and long-term depends upon the how much period the assets has been held. And there are different assets has a different holding period, which needs to be considered. Now, there is also a few exceptions therein, that if I have become owner by virtue of receiving gift, or it has been inherited to me from my ancestors, how do I consider, what cost should I consider, what should be the holding period? It needs to be considered therein. However, in certain circumstances, holding period of previous owner will be considered as held by the person who is selling the asset. And therefore, these are the kind of exceptions we need to consider while classifying it as a long-term or a short-term capital asset. Now, let us look at which are the different kind of assets which has a different holding period. All listed securities, whether equity shares or debentures, if it is being held for up to 12 months, then it will be a short-term capital gain. But if it has been held for more than 12 months, then it will be classified as long-term. Similarly, units of equity-oriented fund, listed or unlisted, both needs to be held for 12 months to be classified as long-term capital. If it is less than that, then again it will be classified as a short-term capital. Unlisted shares, equity preference, whether in India, outside India, it really doesn't matter. In that situation, it has to be held for 24 months. Many a time question arises that if the shares are listed on foreign stock exchange, whether for India tax purposes, whether it will be considered as a listed security or unlisted security. For the purpose of taxation, it will be considered as unlisted securities. And capital gain needs to be considered basis that. Similarly, land and building or both needs to be held for a minimum period of 2 years to be classified as long-term capital gains. If it is less than that, then it will be classified as short-term capital gain. When we are looking at other assets, it has to be held for 36 months. If it is being less than that, then it will be classified as short-term capital gain. Otherwise, it will be classified as long-term capital gain. Now, let us look at how do I compute capital gain and what will be subject matter of taxation. Now, first, what we have to find out at what value it has been sold. In many circumstances, the sale consideration can be replaced with artificial, value of it, such as when I'm selling land and building, and stamp duty valuation is much higher than what has been at what price it has been sold. In that situation, I need to consider the higher value. Similarly, when I'm looking at unlisted security and the valuation which is being determined based on the rules provided under the Indian Income Tax Act is higher than the value at which it has been sold, then I have to consider higher value. So it is a complex way of calculating tax capital gain, but that needs to be considered. From that, what all one can claim as a deduction. First, what we can claim as a deductions, expenditure which are exclusively and wholly incurred in relation to transfer, such as brokerage paid for sale of asset or stamp duty or any other taxes or any other things which are being paid can be reduced from the sale consideration. From there, also one can reduce cost of acquisition or index cost of acquisition in case of long-term asset. Only certain long-term assets will be indexed, not all long-term assets can be indexed. When we say what is index cost, what does it mean? What has happened is that government has identified certain assets to be indexed because of the inflation which is there in India. And they come out with an inflation index number. So one has to just look at what was the inflation index number in the year when it has been acquired and what is the inflation index number when it is being sold, and appropriately cost needs to be enhanced basis those index number, which is known as index cost of acquisition. Similarly, the asset has been improved for various reasons, such as when we are looking at land and building, if the title was not cleared and certain consideration paid to clear the title, or it was it was only a ground floor and one first floor is built on that, that is also considered as cost of improvement, and that also is eligible for deductions. And therefore, either we have to consider cost of improvement or index cost of improvement as the case may be. Similarly, therefrom, what one can also try and claim exemption in respect of certain investments which are being made. Few of the investments which are there is long-term bonds, where certain bonds are there where investment is made. Up to 50 lakh one can claim as a deductions. Many a times, we buy property, but buying property is not an easy task. In those situations, some money needs to be deposited in capital gain saving scheme, and thereafter the same can be utilized for acquiring the assets, and similar things needs to be considered as item eligible for exemption. Therefrom, what one can adjust is that if I have incurred any capital loss in past or in the current year, I can set it off against the capital gain arising therefrom, and only the net gain which is arising will be subject matter of tax. Now, if anything which is to be taxed, and as we were discussing earlier, that there are different rates prescribed for long-term and short-term. What are those and how one needs to look at it? So rates are also specified for different type of assets as well. And let us look at it, what kind of rates which are there. When we are looking at listed equity shares, and only it is in respect of equity shares, where it is short-term capital gain, which will be taxed at 15%. If it is units of equity oriented for, again, even if it is short-term, it will be taxed at 15%. The rest of the securities will be subject to tax based on progressive rate of taxes, and whichever slab which we fall in, which a taxpayer falls in, that rate needs to be applied. Now here, when we are looking at listed securities, one more thing needs to be noted is that it should have suffered security transaction tax at the time of acquisition, also at the time of sale of the assets. Otherwise, these rates will not be applicable, then it will fall under normal rate of tax. Similarly, when we are looking at long-term capital assets, as far as equity shares or equity or oriented mutual fund units are there, if the overall gain is not more than 1 lakh rupees for all capital gains put together, in that case, the same can be claimed as an exempt and not taxable. The moment it exceeds 1 lakh rupees, then the entire gain will be taxable. Let me give you one example. That a person has earned 1 lakh rupees as gain. In that situation, he will not be taxable on the entire gain. But if a person is earning 1 lakh and 1,000 rupees as capital gain, then entire 1 lakh 1,000 will be subject matter of taxation in that situation. Let us look at other securities, unlisted shares, bonds, debentures, or land and building. Everything can be taxed at the rate of 30%. Subject to some assets will be subject matter of index cost, some may not be entitled to indexation. This is how capital gain will normally work in our situation. Let us look at interest income arising therefrom or dividend arising from investment that has been made and how it is to be taxed. Now, dividend as and when it is being distributed by the company to its shareholder out of the profits earned by them will be subject matter of tax. Until a couple of years back, it was not subject matter of taxation, but now it will be taxed at normal rate. Up till last year, it was taxable only at the rate of 10%, but from last year, it has changed to be taxed at normal rate. Now, apart from that, if the dividend received is more than 5,000 rupees from that company, then such dividend will suffer TDS at the rate of 10% in that situation. Similarly, when we are looking at interest income on various investments that are being made, saving account, fixed deposit, and other investments. Now, in that, that interest income will be subject matter of taxation at normal slab rate. And such interest will also be subject to TDS if total interest earned from that company is more than 10,000 rupees or from that asset. Now, in this situation, if company wants to, if a taxpayer doesn't want TDS to be done, then they have to file certain declarations or get a NOC, no objection certificate from the tax officer and submit it to the company so as to avoid any taxation therefrom. Now, this is where we are looking at what capital gain has arose, when we how to make investment, in what investment has to be made, when it is being these assets are being sold or redeemed, at that time what are the tax implications, and during the asset being held, income arising therefrom, how it is to be taxed. So that is how we are just trying to conclude from in which investment needs to be made, how it is to be taxed when it is being matured, and what needs to be taxed when any income arising therefrom. From here, let us take some of the questions which we have on this presentation as well as on certain other aspects.
Thank you, Mayur. Thank you, Ekta. That was very, very interesting. And thank you for simplifying the taxation rules regarding both the various forms of income, which is capital gains, interest and dividend, and also from the perspective of the different investments that can be done by various individuals to try and bring down the tax liabilities. As I had mentioned initially, and I would like to thank all the participants once again for the fantastic response that we've received. We've received more than 500 queries on the subject that we are covering today. And what we will do now over the, let's say, the next 30 minutes or so, is we will try and take up some of these questions which have come up from each of you to get a response from Mayur and Ekta and to help clarify some of the doubts that you have. So Mayur, the first question, and which has come from actually several participants, is on this tax regime. Several years back, the finance minister had introduced a new tax regime for individuals where they had a choice to make between continuing with whatever was existing at that point in time, or moving to the new tax regime where they could opt for the benefit of a higher tax slabs in terms of the deductions that they could enable and the tax that they were payable. But some of these deductions under Section 80C and all those which were not available. So you have the old tax regime versus the new tax regime. So the query that has come from various participants is if you could probably just help identify or throw some light on the difference between these two. And if they had to make a choice, how should they go about deciding on to continue with the old tax regime or to move to the new tax regime?
I think that's a very valid questions which comes from almost everyone. That how do I decide and which regime I need to go for? Now, one needs to understand that when I'm making investment, it is going to earn good return for me. If I go for with the new regime, then I lose a lot of exemptions and deductions which I'm entitled to. As a result, when I lose this exemption, and therefore the lower rate of tax which will apply to me, which is known as new regime. And in that situation, one has to look at it. Now, this is going to be based on individual fact finding in terms of what works for me, what doesn't work for me. Now, if I say broadly, the benefits which are available is around 15 to 20,000. Tax saving which arises in this situation when we go from new regime to old regime, provided the investment or deductions are less than 1,50,000. And I'm just saying in general, in certain situation, this will be more beneficial. If I have some investment in something which is more than that, like say I have a HRA deductions up to say 75,000, and I have 8IC deductions up to 1,50,000. In that situation, I may choose to be governed by the old regime because my deductions will help me reducing my tax rate, or it may bring me to a neutral situation. However, where a person does not want to invest or doesn't want to do anything, and there are no deductions are to be claimed, in those situations, one can always opt for a new tax regime because that will at least reduce some tax for him. And this is only generally being beneficial when a person is getting taxed at lower rate of say 10 to 20%. If it goes beyond that, then it gets marginal benefit, not substantial benefit.
Sure. Thanks, Mayur. So basically, from an individual's perspective, does he have to try out basis his income and the various options which are available? Which option would be beneficial for him? Permutations, combinations, or is there some sort of a thumb rule that they can follow, saying that okay, if my gross income is less than an X amount or more than that amount, then which sort of regime will be more beneficial for that individual? Is there some sort of a thumb rule that they can use, or is it purely by way of trial and error?
No, trial and error will take you to the precise answer. But as a thumb rule, what one can really do is one can consider, if my deductions is more than 1.5 lakh, then I may want to go for old regime. But if my deduction is less than 1.5 lakh, then probably I may stay on with the new regime without worrying about deductions, because that's where there will be more saving. I think this the calculator is also provided on income tax website if somebody wants to try it out, which will be useful for them because it's just a tool which is available on the website. And once try and key in the figures, what works better for them. But thumb rule is, if my deduction is more than 1.5 lakh, then I would definitely go for old regime.
Okay, perfect. Thank you so much. The other question which has come from many participants is on the incidence of taxation, right? You did cover slightly in your talk of in terms of whether tax is payable when we either receive an income or whether it accrues. And this typically happens in products, let's say like a fixed deposit, where you have the option of receiving interest on a regular basis, or you have the option of going in for compounding of that interest and taking the same on maturity, which can be, let's say, 2 years, 3 years, or even a longer duration fixed deposit. Similarly, for interest income, right, on bonds and other instruments where interest is payable, you have that option of taking on a regular basis or postponing it and taking it only on maturity. So we have different opinions which come in from different professionals saying that whether it is payable, the tax is payable only when you actually receive that income, or does it need to be accounted for every year even though you've not received it and tax is payable on that. So if you could probably just help clarify that. And also a question which has come similarly in the form of salary, right? So let's say in the case of salary which is payable by an employer to an employee for the month of, let's say, a Jan, Feb, March, but the actual salary for whatever reason, and we've seen that happening during the pandemic, where the salary payment has actually been postponed by a few months for certain individuals, where they've received it in the next financial year. uh, what is the incidence of taxation, and when should actually an individual consider that?
Sure. So as far as interest and dividend income is concerned, these are classified under Indian income tax rule as in other income or income from other sources. Now, income tax has given a choice, once in a lifetime choice, to be exercised by the person, whether they want to follow cash basis of taxation or to follow accrual basis of taxation. When I say cash basis of taxation, means as and when it is being encashed or credited to my account, at that time I need to offer it to tax, or I can offer it as and when it is being accrued, though it has not been credited to my account. Once a person has exercised his choice in the first year, the same has to be followed by the person throughout, whenever till the date when he is filing the return. He can always change this method subject to the tax officer approving change of the method with appropriate justification why one needs to change this. And that needs to be taken care of. As far as salary income and other incomes are concerned, only business and income from other sources can be followed by this method with an option given by the tax officer. But otherwise, every other income needs to be offered to tax based on as and when it is being accrued. As far as salary is concerned, many a time salary for the month of March is paid in the month of April. However, it will be taxable in the month of March. Similarly, we spoke about capital gain. When any asset is being sold in year one, but payment is received in year two, then the taxable event will trigger in year one and not in year two. So likewise, one has to consider that taxable year or when the income is taxable depends upon which method of accounting we have followed for interest, dividend, and accordingly it has to be taxed. And therefore, it can vary for, say, taxpayer one and taxpayer two. Taxpayer one may follow accrual system of taxation, whereas taxpayer may follow cash basis of taxation. So that is the choice which a taxpayer has to exercise, and once it is exercised, then he has to follow continuously the same method unless the tax officer allows him to follow another method.
Perfect. Thank you so much. I think that was very clear. So, as just to summarize, what you said is that the choice to follow cash basis or accrual basis is left to the investor, but that's a decision that he or she needs to take, and which is, let's say, once in a lifetime sort of a decision. You can't keep changing that every financial year or on a regular basis.
That's correct.
Sure. There are quite a few queries which have come from the participants on the housing and the properties which they own, the implications from tax, let's say the loan that they have taken, the interest that they pay, the HRA that they receive. So I'll just take up a couple of these queries. So one is from individuals who have multiple houses, right? It could be in the same city, it could be in different cities, where they have taken a loan to purchase these properties. Right? So one is if they own multiple houses, either in the same city or different cities, and a loan has been taken. What about, let's say, the deductions which are available both on the interest component as well as on the principal repayment? How does that work for an individual in such scenarios?
Sure. So, see, if they have multiple houses, there can be it can be a different scenario. Say, for example, if an individual is having a self-occupied house property, they can claim the deduction for their interest up to INR 2 lakh per year. Additionally, the principal repayment amount is available as a deduction under Section 80C. If you are a first-time home buyer and it's an affordable house, then you may also be eligible to claim the additional deductions which we spoke about under Section 80E and EEA, depending on various other conditions have been met or no. Additionally, if he has multiple houses and say, for example, the second house is a let out house property, then the individual needs to offer the rental income to tax. He can claim the deduction of interest that is paid by him on that house property without any limit. However, when the income from both the houses will be offset against each other, the maximum income loss from house property, if any, that can be carried forward for adjustment against other income is restricted only to INR 2 lakh per year. Additionally, say if a person is not having any house property and is living in a rented apartment, then they have a benefit of claiming HRA from their salary income, provided HRA allowance is being paid to them.
Okay, so there are quite a few permutations and combinations which are possible over here, and it will all actually depend on a case-to-case basis and the specific scenario of that individual on how the implications and the incidence of taxation would be.
Absolutely.
Right? If let's say these houses, whether they are in the same city or different cities, does that have any implication on the taxation, or that is not really relevant over here?
Yes. So, if say both the houses are owned by the individual itself, then there will not be any implication from a tax perspective, because the tax does not provide a restriction on where the properties have to be located in terms of your deduction for home loan interest under various sections. However, if we are looking at an HRA exemption, then the location of the house property may matter, because you should not be owning a house property in the same city.
Just to add to what Ekta is trying to say, and I'll just take one example, in the sense that when a person is owning a property in say hometown, but he has to go for work in some other town. In that situation, what normally we have seen is that hometown property is always rented out, and rent is received in respect of that. But while the person is working in the other city, in that situation, he may not own a property there, and there he is taking property on rent. Now, in that situation, he maybe want to claim HRA as an exemption from salary income. At the same time, he owns a property. Given that HRA has a condition that when you are claiming exemption, you should not own a property. But in this situation, when property is owned in another city and it is being rented out, in that situation, HRA exemption can be claimed. And if this property is there, whether it is taken on loan, rented out or not rented out, the interest deductions would be available, and those advantages can be taken. So this is the one thing which we all need to know. There are certain conditions. If you are meeting that, then one will be able to claim these deductions. However, tax officer is likely to take another view, but in the court, this has been proved that these deductions is available. Both the deductions, HRA as well as interest deductions, are available, and court has approved this. However, tax officer may not accept and get into a litigation in this situation.
Sure. Thank you so much. There is one more scenario over here which we typically see. Of course, you do explain the scenario where people move from their hometown to a different city within India for their employment. But given, let's say, that the boom that we are seeing, let's say in the IT sector and other services sector, we also have various salaried individuals who actually go to a different country and take up, let's say, property over there from on a rental basis, while they continue to own, let's say, property here in India. It could be in one city or in different cities as well. So that rule that you explained about different cities, does that still also apply if, let's say, the individual is actually going overseas and taking some property on rent in a different country?
Yes, it do apply. I don't think there is any restriction whether property should be in India or overseas. And one can always claim HRA exemption in respect of even property which is being occupied outside
Oh, great. Thank you so much. Um, in terms of the capital gains, when you did explain all the different permutations and combinations between short term and long term, the expenses which can be deducted, the tax rates, and the period of holding, there is also a certain provision about offsetting losses. So one is, let's say, the capital gains part. But in some cases, while you do make some gains, in other instances, you end up making losses as well. And these losses can actually be set off in certain cases against the gains that you've made to ensure that you pay a lower taxation. I know that it is a very elaborate section in terms of how you can adjust these losses against the gains. But if you can possibly just take, let's say, a couple of minutes to explain how does this set off of losses work, it will just help all the participants on the call.
Sure. So in case of, say current year losses, I think some principle I'll just try and explain that when we are looking at short-term losses, that short-term losses can be adjusted against short-term capital gain and long-term capital gain. Whereas any long-term losses which are there can only be adjusted against long-term capital gain. Both the losses can be carried forward. If it cannot be set off against the entire capital gain, then it cannot be adjusted against any other income, any other source of income, and it has to be mandatorily carried forward to the subsequent tax years. Now, when we are carrying it for subsequent tax years, it can be carried only up to 8 years, and it cannot be carried beyond 8 years. And again, there the rule will apply that short-term losses can be set off against short-term or long-term, but whereas long-term capital losses can be only set off against long-term. If up till 8 years it cannot be set off, then all these losses will lapse and it will become zero after 8 years. And this is what general principle needs to be applied in in setting off all the losses arising on account of transfer of any capital asset.
Sure. Thanks. Thanks so much. I mean, I do understand that, let's say, this is a quick overview of let's say, the entire offsetting, and it's much more elaborate, but at least that will help to a certain extent in broadly understanding the requirements over there. We also have a couple of questions coming in on insurance, given that it is one of the key aspects that people consider under the Section 80C to reduce, let's say, the taxation. Last year, there was a clause introduced on limiting if, let's say, that insurance is a ULIP plan. Right? There's a certain maximum amount which was specified up to which investments can be done in a ULIP plan versus, let's say, a non-ULIP plan. Anything that you could highlight over here in terms of the limits which are available and how it could be used to plan their investments?
Sure. So any deduction under 80C, whatever contributions are being made under ULIP will be restricted to 1.5 lakhs only, which is the deduction aggregate which is available for 80C.
Right. So that's the deduction. But there was also something about, let's say, a limit of 2.5 lakhs where it becomes that the income doesn't become tax-free at the end of maturity or something which had come in, and we have a few queries coming in on that. So, I mean, is that something that you could help clarify, or do we take it up slightly later?
Sure. So, are you referring to the ULIPs where the annual premium paid by
more than 2.5 lakhs? That's
exceeds 2.5 lakh.
That's right.
In that, there was a latest CBDT notification which said that if the aggregate premium exceeds 2.5 lakhs, then the exemption will not be available for the new ULIP. If so, for example, if you have invested in one ULIP plan where you're paying a premium, and then you take another ULIP plan where you're paying some additional premium, and say the aggregate of the premiums which is paid for both the ULIP plans exceeds 2.5 lakhs, in that situation, the exemption will not be available at the time of maturity.
Okay. Okay. Thanks so much. We have a lot of questions coming in on behalf of NRI customers. I mean, given that we have a large diaspora who is outside of India, and they obviously have a lot of queries relating to taxation in India because they deal with tax in two different countries. So I'll just take up a few questions which have come in from our NRI customers. So first and foremost, the most simple thing is if they are NRIs and they have been staying overseas, do they actually have to file returns in India or not? So that's the most basic sort of query which is coming in.
Yeah. So when any NRI who has income about 2.5 lakh, which is the threshold, in that situation, such NRI also needs to file the return. However, certain NRIs are exempt from filing the return, provided the investments are made in through inward remittance, and the income tax thereon is withheld in accordance with the income tax provisions. In those situations, and they have only that source of income, in that situation, they are being exempted from filing the return. And in those situations, they are not required to file any return of income. But however, if there is any claim of a refund to be made, in that situation, they are required to file the return so as to get the refund.
Okay, great. So that is, let's say, from an NRI perspective. You also have scenarios where, let's say, salaried individuals keep traveling overseas for shorter duration of times. I mean, for a couple of months for specific projects. And there are certain scenarios when they have to travel for longer durations and stay overseas for, let's say, 2 to 3 years or more, right? So how should they look at, let's say, taxation from an India perspective? So let's say somebody who's going in for, let's say, a 2 to 3, 4 or 5, 6 months period versus somebody who's going in for a longer stay, let's say about 2 to 3 years or so. Is there any difference in the taxation from an India perspective, and how should they look at this?
Sure. So in those situations, there are a couple of things one needs to note. Is first and foremost, what they have to determine is that under the Indian income tax regulation, are they getting classified as a resident or a non-resident? If they are getting classified as a resident, and more likely than not, they would also get classified as ordinary resident. In that situation, entire income, global income needs to be offered to tax in India. Also, which would mean that salary income, which is arising from employment exercise outside India, or any other income which is arising outside India, would also be subject to tax in India. Depending upon the double taxation avoidance agreement which India has entered with that country in which the person was performing his services, either tax credit will be given to that person in India, or such income can be claimed exempt, or it can be claimed at a lower rate of tax. That all depends upon the double taxation avoidance agreement which is signed by India with that country. More often than not, what typically works out is that they will be end up taking credit of taxes paid in overseas jurisdiction. And to do that, there are several forms needs to be filed, and appropriate evidence needs to be produced to claim those foreign taxes as credit against the Indian tax liability. Let us take one example that a person has earned in overseas jurisdiction 10,000 as salary, and on which 25 is being paid as taxes in that country, and in India he is being taxed at say at the rate of 30. Then in India the person needs to pay 30 minus 25, so only 5 rupees as taxes which needs to be paid in India and not entire 30. This is how it can work out.
Okay, great. Um, a different profile of individuals over here is the returning NRIs, right? So, I mean, people who stayed overseas, we are also seeing a lot of them now coming back to India, either for employment or starting a new business. So, one question which is coming from many of them is that what happens to all the investments that they have done overseas while they were residents in a different country? Do they necessarily need to exit them and bring that money back to India when they are returning here? So that is one part of the question. The other is that they also have investments in India, let's say in the form of NRE deposits or FCNR deposits, which still have some time to maturity, right? So it's not matured when they have actually returned to India. So can they continue with these investments? And if yes, then how does the, let's say, the tax implication work? Because typically while they are NRIs, any investments that are done in NRE or FCNR deposits, they are tax exempt in India. So if, let's say, the status is changing and they're returning back to India, then what happens to some of these deposits which still continue? Do they still remain tax exempt, or are they taxable then for them?
Sure. So there are two questions which has emerged in this discussion. One which relates to exchange control regulation. That what happens to the assets which I had acquired when I was a non-resident, and what happens to that? This question needs to be answered from exchange control perspective as far as India income tax is concerned. I don't think it has any bearing on that. It will be still considered as income in India and it will be subject to tax. When from an exchange control perspective, when any assets which is being owned when a person was non-resident, he can continue to hold as a foreign assets, and he does not necessarily have to bring it in India, and he can retain it outside India. He can invest or reinvest or reconvert into any form. And I don't think there are any exchange control regulation which prohibits him or requires him to bring that money into India. When he was a non-resident, whatever deposit, fixed deposit which he has made, which can continue to be held under exchange control until it gets matured. Upon it getting matured, and if it is being NRE, they can convert into foreign currency non-resident, resident foreign currency account, and they can keep it over there. As far as income tax is concerned, till it is being held in NRE, and NRE as per RBI regulation, that can continue to avail the exemption which is available. The moment it gets matured, this exemption will be revoked, and the money is transferred to RFC account, resident foreign currency account, and any income arising therefrom would be subject to tax in India.
Okay, great. Thanks. Thank you so much. I know we are coming to the end of the time that we scheduled today, but there are two very common queries which are coming in. And what we've tried to do is we've tried to take questions from the different profile of all the participants. Another profile is the senior citizens, right? I mean, given the fact that they don't have regular income coming in now, and they are largely dependent on the income that they make out of all the investments that they have done over the lifetime. The question that is coming is are there any specific provisions from a senior citizen perspective in the income tax which can help them save additional amounts or reduce the tax outgo? That is one. And secondly, depending on the income that they are earning, are they still liable to paying advance tax every quarter, or whether the advance tax provisions are not relevant from there?
Sure. Picking up the second one first, because I think that's the easy one. So advanced tax provisions do not apply to senior citizens. So they do not need to pay advance tax on a quarterly basis. There are a few provisions which are additionally available, which gives some additional tax benefits for senior citizens. Like, for example, the deduction, which is available for a non-senior citizen of 10,000 on a saving interest. That for a senior citizen increases up to INR 50,000 on an annual basis, and it is not only for saving interest, but it is all kinds of deposits, like including term deposits, saving interest. Typically, for a senior citizen, where most of their income will be derived, presumably from interest income, this is a very beneficial provision. Additionally, from a tax rate perspective, up to INR 5 lakhs for a senior citizen, presuming they are residents of India, there is a rebate available, and there will be no taxation for such individuals in India.
Okay. Thank you. Thank you so much. The other most common query which has come, and which is why I saved it for the end, is in terms of all the various investment options that you listed out earlier, right, from whether it is an insurance policy or a provident fund, fixed deposits, ELSS, and all of those. So the most common requirement is how should one choose, let's say, one or more of these options within that limit of 1.5 lakhs in a manner which gives them the highest return, and which is least in terms of the lock-in period, because each one has a different lock-in period, right? So while whatever information that you can share, and then probably I could just add a couple of points from our side also on that, it could help the participants over here.
Sure. I think that it would depend on an individual's financial capital requirement perspectives, so that they can decide on how much lock-in period is practically feasible for them when they would be needing to liquid funds for their daily requirements, etc. And how much risk appetite an individual really has in terms of, for example, really investing in a public provident fund vis-a-vis a unit of ELSS or ULIP. The risk appetite is also something which one needs to really consider when they are investing in these particular investments. And more or less from a tax perspective, they are giving similar deductions only. So I think you would be able to add a few more points more from a financial perspective there.
Sure, absolutely. Thanks, Ekta. So just to add to what Ekta said, I mean, of course, we have gone through the various options which are available to you under the Income Tax Act, where you could take advantage of the 1,50,000 deduction which is available. Now, each of those has a different lock-in period. So, for example, ELSS schemes which are provided by various mutual fund houses, there is a lock-in period of 3 years, right? However, the returns over here are not fixed, not guaranteed. It will depend, since the underlying investments is in equity shares, the returns will completely depend upon the market performance and how, let's say, the investments are done by the fund manager. So while the lock-in period is the least over here in ELSS schemes, however, the returns are not guaranteed, and the returns will depend upon the risk appetite that you are willing to take, given that the underlying investments are in equity shares. Other than that, you have, let's say, fixed deposits which are offered by the bank, where there is a 5-year lock-in period. The returns are guaranteed, but however, these returns are, let's say, obviously fixed and slightly lower in compared to other options which may be available because of the safety that they guarantee. But as I mentioned, that these are locked in for a period of 5 years. Okay. Then you have insurance policies where, in addition to the tax benefit that you get, the most important part is that your life is also covered from an insurance perspective. So there are two benefits that you need to look at over here. One is, of course, a deduction that you're getting from an income tax perspective. And second, also the fact that you are getting a life insurance cover. And if, let's say, there is an unexpected incident which happens, which we really hope that it does not, but then at least it helps your family to the extent of the sum assured, where they get that additional benefit to ensure that the lifestyle that they are used to can continue without any implications or any setback over there. So you need to cover all of these different aspects when you decide whether you need to go in for a life insurance policy, or whether you go in for an ELSS scheme, or whether you go in for a fixed deposit which is available. Additionally, you also have the NPS, which is now available as an option where you can go in for an additional 50,000 as well. where there is an option for you to decide between equity and fixed income as an allocation, right? But there again, the lock-in period is much longer, right? And then there are certain other provisions which are available depending on a case-to-case basis. For example, the Sukanya Samriddhi scheme, which is available to you as an option only if you have a child who's a daughter and who's less than 10 years old, where again the lock-in period is much longer till the child attains a certain age. So from that perspective, depending on specific requirements, there are multiple options which are available to you. The one that you pick and choose will obviously depend on one which is most suitable to you, both from a time perspective, which is the lock-in period which is available, the returns which are possible from that, and obviously the risk also of the underlying, because in some cases the returns are guaranteed, in some cases the returns are open-ended and will depend upon the performance of the underlying investment. So here, at least what we would suggest is that you get in touch with a professional, either a banker or your advisor or your relationship manager or your chartered accountant, whoever you think could best help you in terms of deciding and then taking a joint call on all these aspects. So we know, I mean, unfortunately, we had scheduled, let's say an hour for this entire discussion today. What we've really tried to do is we've tried to take on questions from different profile of the participants today, which we thought would help them in terms of planning the taxation, given that we are at the end of the financial year. We have about 30 odd days left in this financial year to take advantage of any provisions which we feel we have not been able to take advantage of during the year. Right? We do hope that we've tried to cover most of the common queries. For sure, we've not been able to cover, since, as I mentioned, we've got more than 500 questions which have come in today from all of you. We've definitely not been able to cover all the different queries. We will try and probably schedule another call maybe slightly later to see if we can take up some of the additional queries that have come in. But we do hope that whatever we've tried to cover today in the limited time that is available to us, we've tried to address some of the more common queries. Right? So on behalf of Axis Bank and on behalf of Ernst Young, a big thank you to Mayur and Ekta for taking time out today to address some of these common queries and concerns that we have. And thank you to all the participants who've taken time out on this weekend to join us for this discussion today. If you do have any other common queries, would request you to get in touch with your Axis Bank branch. And if they could forward that to us, we will try and address these queries separately as well. So on behalf of all of us over here, thank you so much for joining in today. And thank you once again to Mayur and Ekta for taking the time out today. Thank you so much.
Thank you.
Thank you.